Chapter 17, Financial System and Financial Market. Financial markets are of utmost importance in the modern era. These markets facilitate the trading of financial instruments of various kinds, such as deposits, bills, and bonds, etc. This chapter studies about financial market, regulatory bodies, and its instruments, etc. Financial system. Financial system provides the broad framework under which financial institutions mobilize savings, allocate them in profitable investments, and control and manage these investments. An economist has defined financial system as an interrelated groups of financial institutions, markets, tools, services, etc. In broad sense, financial system refers to that system which facilitates close relation between savings and investments and helps in their mobilization, planning, management, and control. Characteristics of financial system: it creates a bridge between investors and companies. Financial resources are collected, planned, and managed under the purview of financial system. Financial system ensures accountability to investors. The circular flow of economic development in the continuous form is a part of financial system. Components of financial system. It is depicted below. Financial system of India, financial market and financial institutions. Financial market, money market, capital market. Money market, organized money market, unorganized money market, capital market, primary market, secondary market. Financial institutions, banking, banking institutions, non-banking institutions. Indian financial system. The financial system of India can be broadly classified into the organized and unorganized financial system. The organized financial system comes under the purview of the Ministry of Finance, the Reserve Bank of India, the Securities and Exchange Board of India, Insurance Regulatory and Development Authority, and other regulatory bodies. The unorganized financial systems are not regulated in a systematic manner by the government or any authorized regulators. It comprises of relatively less controlled money lenders, non-bank financial intermediaries, and the indigenous bankers. Individual money lenders such as neighbors, relatives, local bankers, landlords, etc. are main parts of unorganized financial systems. Financial market. A financial market is a market where financial instruments are exchanged or traded. A financial market is a mechanism that allows people to buy and sell financial securities and commodities at efficient market prices. In broad terms, financial market is the marketplace where buyers and sellers participate in the trade of assets such as equities, bonds, currencies, and derivatives. Financial markets are one of the important components of the financial system. They create a mechanism for the exchange trading of financial products guided by a policy framework. The borrowers, issuers of securities, lenders, buyers of securities, and financial intermediaries are the participants in the financial markets. Financial markets perform various functions such as risk diversification and reduction, efficient payment mechanism providing information about companies, transformation of financial claims to suit the preferences of both savers and borrowers, and enhancing liquidity of financial claims through trading. Characteristics of financial markets. Financial markets have a large volume of transactions, and the speed with which financial resources move in this market is very high. There are various segments of financial markets such as money market and capital market. Primary and secondary segments, stock markets, bond markets, etc. There is scope for instant arbitrage among various markets and types of instruments. Financial markets are highly volatile. Panic and distress selling by a limited group of operators can spread as a general tendency. Financial intermediaries are the dominant participants in the financial markets, and they take investment decisions as well as risk on behalf on their depositors. Financial market provides a channel through which new savings help to aid capital formation of a country. There is need for regulation of financial markets in order to safeguard the interest of the investors. Financial market consists of organized and unorganized market. Organized market can be further divided as money and capital market. Money market, the group of financial institutions that deal in short-term securities and loans, gold and foreign exchange are collectively referred to as money market. The money market is a key component of the financial system. It is a market for short-term funds with maturity ranging from overnight to 1 year and financial instruments that are deemed to be close substitutes of money. Functions a role of money market. It provides an equilibrating mechanism for demand and supply of short-term funds. It enables borrowers and lenders of short-term funds to fulfill their borrowings and investment requirements as an efficient market clearing price. It provides an avenue for central bank interventions in influencing both quantum and cost of liquidity in the financial system, thereby transmitting monetary policy changes to the real economy. Money market smoothens the progress of financial intermediation and boosts lending to economy. Money market performs the function of a wholesale market of short-term debit instruments. Types of money market. Organized money market. It is dominated by commercial banks. The other major participants are the Reserve Bank of India, Life Insurance Corporation, General Insurance Corporation, Unit Trust of India, Securities Trading Corporation of India Limited, Discount and Finance House of India, other primary dealers, commercial banks and mutual funds. The core of the money market is the interbank call money market, whereby short-term money borrowing lending is effected to manage temporary liquidity mismatches. The Reserve Bank of India occupies a strategic position of managing market liquidity through open market operations of government securities, access to its accommodation cost, interest rates, availability of credit and other monetary management tools. Unorganized money market. There is still an active unorganized market in spite rapid expansion of the organized money market through a large network of banking institutions that have extended their reach even to the rural areas. It consists of indigenous bankers and money lenders. In the unorganized market, there is no clear destination between short term and long term finance and even between the purposes of finance. The unorganized sector provides finance for trade as well as personal consumption. Sub markets of money market. The money market is characterized by the presence of many financial institutions which deal in financial tools through sub markets. Some important sub markets of Indian money market are discussed as follows. Call money market. The most important components of organized money market is the call money market. It deals in call loans or call money granted for 1 day. The participants in this market are mostly commercial bank. Therefore, it is also referred to as interbank call money market. Mivar, Miviv, and Liver. The National Stock Exchange has declared the following rates of the call money market, which have become effective from 15 June 1988. Mumbai Interbank Offer Rate MIBOR. It is the lending rate. Mumbai Interbank Bid Rate MIVID. It is the borrowing rate. London Interbank Offered Rate LIVOR. Liver. It is the benchmark rate. Treasury bill market. This market deals in short-term treasury bills with maturity of 91, 120, 182 or 364 days. These bills represent the liability of the government which are issued to meet its short-term financial requirements. The treasury bills can further be categorized as ad hoc treasury bills. These bills are issued to the state governments, semi-government departments, and foreign central banks. Regular treasury bills. These bills are sold to the banks and public and are freely marketable. Commercial bill market. The underlying purpose of developing the bill market was to enable banks and other financial institutions to invest their surplus funds profitably by selecting appropriate maturities. Instruments of money market. Indian money market at present has wide variety of instruments. These instruments are as follows. Call notice money. This is a tool to mobilize very short term funds. Call money refers to the borrowing or lending of funds for one day. In the notice money market, overnight money and money at short notice up to a period of 14 days are lent at borrowed without collateral. This tool enables banks to bridge their short term liquidity mismatches arising out of their day to day operations. The call money market in India was purely an interbank market until 1971, when the erstwhile Unit Trust of India (UTI) and Life Insurance Corporation (LIC) of India were allowed to participate as lenders. Treasury bills, T-bills. It is a very low risk instrument for short term borrowing by the government. The bills are issued by tender to the money market and to government departments through tap issues. Tenders are invited every week from bankers, discount houses, and brokers. The Reserve Bank of India, being the bankers to the government, issues treasury bills at a discount. There are four types of treasury bills. 14-day T-bills. It was introduced in 1997 by the RBI. Maturity is in 14 days. It is auctioned on every Friday of every week, and the notified amount for auction is 100 rupees crore. 100 crore. 100 crore. 91-day T-bills. Maturity of this bill is in 91 days. It is auctioned on every Friday of every week, and the notified amount for auction 100 crore. 182-day T-bills. Maturity of this bill is in 182 days. It is auctioned on every alternative Wednesday, which is not a reporting week, and the notified amount for auction is 100 crore. It was introduced on the recommendations by Waghul Working Group. 364-day T-bills. Maturity of this bill is 364 days. It is auctioned on every alternate Wednesday, which is the reporting week, and the notified amount for the auction is 500 crore. It was also recommended by Waghul Working Group. Certificates of Deposit (CDS). Certificate of Deposits is negotiable claim issued by a bank in return for a term deposit. Certificates of deposits are securities that are purchased for less than their face value, which is the bank's promise to repay the deposit and thus offer a yield to maturity. Certificates of deposits were first issued in New York in the 1960s. Certificates of deposit series were introduced in India in June 1989. Financial institutes can issue CDs for a period not less than 1 year and not exceeding 3 years from date of issue. Minimum period is not less than 1 year. Commercial paper. Commercial paper (CP) is issued in the form of a promissory note sold directly by the issuers to investors or else placed by the borrowers through agents such as merchants, banks, and security houses. Maturity period is minimum 7 days and maximum of up to 1 year from the date of issue. They are negotiable and transferable by endorsement. Commercial paper (CP) is an investment instrument which can be issued by a listed company having working capital or more than or equal to 5 crore. The CPs can be issued in multiples of 25 lakh. CP was introduced in India in January 1990 in pursuance of the Waghul Committee recommendations in order to enable highly rated non-bank corporate borrowers to diversify their sources of short-term borrowings, and also provided an additional instrument to investors. CP could carry an interest rate coupon but is generally sold at a discount. Since CP is a freely transferable, banks, financial institutions, insurance companies, and others are able to invest their short-term surplus funds in a highly liquid instrument at attractive rates of return. Repo is a money market instrument which helps in collateralized short-term borrowing and lending through sale or purchase operations in debit instruments. Initially, repos were allowed in central government, treasury, bill, and dated securities created by covering some of the treasury bills. RBI gradually allowed repo transactions in all government securities and T-bills of all maturities, and now state government securities, PSUs, bonds, private corporate securities have also been made eligible for repos to broaden the repo market. Money Market Mutual Funds, MMMFs. The scheme was introduced by RBI in April 1992 with the objectives of providing an additional short-term avenue to the individual's investors. They have now been brought under the purview of SEBI since March 2000. Commercial bills. Commercial bills is an unsecured short-term debit instrument issued by a business firm for meeting short-term liabilities. Bill of exchange are negotiable instruments drawn by the seller's drawer on the buyer's drawee for the value of the goods delivered or to him. Such bills are called trade bills. When trade bills are accepted by commercial banks, they are called commercial bills. Demand bill, clean bill, documentary bill, inland bill, Hondy, foreign bill, derivative and cents. Promissory note are the type of commercial bills. Capital market. Capital market is one of the most important segments of the Indian financial system. It is the market available to the companies for meeting their requirements of the long-term funds. It refers to all the facilitators and the institutions arrangements for borrowing and lending funds. In other words, it is concerned with the raising of capital for purposes of making medium and long term investments. Functions a role of capital market. The capital market functions as a link between savers and investors. It plays an important role in mobilizing the savings and diverting them in productive investment. Capital market provides operational efficiency through simplified transactions procedures, lowering settlement timing and lowering transactions cost. Capital market develops integration among real and financial sectors, equity and debit instruments, long-term and short-term funds, long-term and short-term the interests cost, private and government sectors and domestic and external funds. Capital market improves the efficiency of capital allocations through a competitive pricing mechanism. Capital market provides liquidity with a mechanism enabling the investors to sell financial assets. Capital market encourages broader ownership of productive assets. Capital market disseminates information efficiently for enabling participants to develop an informed opinion about investment, disinvestment, reinvestment, or holding a particular financial assets. Capital market enable quick evaluation of financial instruments, both equity and debit. Capital markets provide insurance against market risk or price risk through derivative trading and default risk through investment protection fund. Capital markets enable wider participation by enhancing the width of the market by encouraging participation through networking institutions and associating individuals. Types of capital markets. Primary market. The primary market provides a channel for sale of new securities. Primary markets provides opportunity to issuers of securities, governments, as well as corporates to raise funds to meet their requirements of investment and or discharging Some obligations. The primary market deals with the issue of new instruments such as equity shares, preference shares, and debit instruments by the corporate sector. Central and state government, various public sector industries, unit PSUs, security, and other authorities such as state electricity boards and port trust also issue bonds, debit instruments. Therefore, it is also called the new issue market (NIM). The primary market is one in which public issue of securities is made through a prospectus in a retail market, and there is a physical location. Secondary market. It is a market for trading and settlement of securities that have already been issued. It is a market where securities are traded after being initially offered to the public in the primary market and or listed on the stock exchange. Secondary market comprises of equity and the debit markets. In secondary market or stock exchange, the investors holding securities sell securities through registered brokers of the stock exchange. Investors who are interested in buying securities purchase securities through registered brokers of the stock exchange. It may have a physical location like a stock exchange or a trading floor. The secondary market consists of 23 stock exchanges. The secondary market provides a trading place for the securities already issued to be bought and sold. Capital market of India. The capital market of India is among the top 10 biggest capital markets of the world and provides a variety of capital market instruments. There are 23 well organized stock markets in India, among which the Bombay Stock Exchange BSE and the National Stock Exchange NSE hold the dominant positions. In India, the capital market is regulated by the Capital Markets Division of the Department of Economic Affairs, Ministry of Finance. The division is responsible for formulating the policies related to the orderly growth and development of the securities markets, share debates and derivatives, as well as protecting the interest of the investors. In particular, it is responsible for institutional reforms in the securities markets, building regulatory and market institutions, strengthening investors protection mechanism, and providing efficient legislative framework for securities markets, such as Securities and Exchange Board of India Act 1992, SEBI Act 1992, Securities Contracts Regulations Act 1956, and the Depositors Act 1996. Some important capital markets. Gilt edged market. Gilt edged market refers to the market for government and semi government securities backed by the Reserve Bank of India RBI. Government securities are tradable debit instruments issued by the government for meeting its financial requirements. The term gilt edge means of the best quality. This is because the government securities do not suffer from risk of default and the highly liquid, as they can be easily sold in the market at their current price. The open markets operations of the RBI are also conducted in such securities market. In this market, long-term financial needs are fulfilled by issuing shares, bonds, debentures, mutual funds, etc. Various types of transactions are settled in this market. Profit on sale or purchase of securities are taxable under the head long-term capital gains. Bond market. Bond market is a market in which the participants can issue new debit and can deal in the sale and purchase of debit securities. This market is also referred to as credit market or debit market. The primary objective of this market is to raise long-term finance for private or government expenditures. Government businessmen, institutional investors, etc. deal in this market. Some of the important bonds are green bond. A green bond is like any other regular bond, but with one key difference: the money raised by the issuer are marked towards financing green projects, assets, or business activities that are environment friendly. Such projects could be for renewable energy, clean transportation, and sustainable water management. Yes Bank was the first bank to come out with issue of a green bond in 2015. Masala bond. Masala bond are the bonds issued outside India but dominated in Indian rupees rather than the local currency. By issuing bonds in rupees, an Indian company is shielding against the risk of currency fluctuations typically associated with the borrowing in foreign currency. Indian companies were permitted to sell masala bond in 2015 by former Finance Minister Arun Jaitley. Share market. Share market is generally used to represent the secondary market. In this market, various types of securities such as shares, debentures, bond, etc. are regularly sold and purchased. It provides for an immediate and continuous market, a secure market information related to sale, purchase price, mobilization of savings, measures of economic development. Types of shares. Any company can issue the following types of shares: equity shares, shares which do not carry any preferential right as to payment of dividend or repayment of capital are referred to as equity shares. Dividend on these shares is paid only after the payment of dividend on preference shares. Also, the rate of dividend on these shares is not fixed. The capital raised from the issue of their shares is a part of owner's equity. Preference share. The shares which carry preferential rights as to payment of dividend and repayment of capital are referred to as preference shares. Dividend of these shares is paid at a fixed rate prior to any payment of dividend to equity shareholders. However, these shares do not carry any voting rights. Capital market instruments. Global Depository Receipts (GDR), American Depository Receipts (ADR). Foreign investors investing in the Indian stock markets can do so through GDRs and ADRs. However, they need to comply with various regulations of the securities market regulators, the Securities and Exchange Board of India (SEBI), and the Central Bank, the Reserve Bank of India (RBI). Further, their investments and are settled through the Indian settlement system, where receipts and payments are made in the Indian rupee. Convertible preference shares. The preference shares that are convertible into equity shares are called convertible preference shares. Depending on the term of issue, they are either compulsory convertible or optionally convertible. Debentures. These are a form of debit security which are issued by companies. They may be secured against fixed assets. In that case, these are called secured debentures. Others are unsecured, as with preference shares. They may be convertible, compulsory, or optionally, or they may be non-convertible. Foreign currency convertible bonds. These are debit securities issued by companies and denominated in foreign currency. Further, they are compulsory or optionally convertible into equity shares of the company. Government securities. They are issued by the Government of India for government's requirement of funds. Further, the yield on government securities in the market sets the benchmark for yields on other debit securities. It is totally secure financial instruments ensuring safety of both capital and income. Difference between capital market and money market. Basis meaning হচ্ছে money market. It is a market for short term loadable funds for a period or of not exceeding 1 year. It is capital market. It is a market for long term funds exceeding a period of 1 year. Money market. Regulatory body. It is a regulatory and executed by RBI. Capital market is regulated and executed by SEBI. Money market transactions have to be conducted without the help of brokers. Or capital market transactions have to be conducted only through authorized dealers. Or money market institutions. The central bank and commercial banks are the major institutions in the money market. Or capital market development banks and insurance company play a dominant role in the capital market. Money market instruments. The instruments of money market are bill of exchange, treasury bill, commercial paper, certificates of deposit, etc. Or capital market. This market deals in instruments like share, debentures, government bonds, etc. Stock Exchange of India. Stock exchange are the exclusive centers for trading of securities. They are a sensitive barometer and reflect the trends in the economy through fluctuations in the prices of various securities. It has been defined as a body of individuals where incorporated or not constituted for the purpose of assisting regulating and controlling the business of buying, selling, and dealing in securities. As mentioned above, there are 23 well organized stock markets in India, among which the Bombay Stock Exchange BSE and the National Stock Exchange NSE, along with OTCEI and ISE, hold the dominant positions. Types of transactions facilitated through stock exchange. Two types of transactions take place in stock exchanges. These are as follows: investment transactions, sale or purchase of securities undertaken with the long-term prospects of rating their yield and price. Speculative transactions, sale or purchase of securities undertaken with short-term gain from differences in yield and price. In this, delivery of securities of the or the payment of full price is rare. Speculative transactions is of different types, which are as follows. Spot transactions involves delivery of and payment for securities on the same day. Cash transactions is ready delivery transactions wherein delivery of and payment for securities is completed within a period of 1 to 7 days. Forward transactions involves delivery of and a payment for securities will be made on certain fixed settlement days, coming once in 15 or 30 days. Approved stock exchanges in India: UP Stock Exchange Kanpur, Barodara Stock Exchange Barodara, Coimbatore Stock Exchange Coimbatore, United Stock Exchange of India Limited, Bombay Stock Exchange Mumbai, Over the Counter Exchange of India Mumbai, National Stock Exchange Mumbai, Ahmedabad Stock Exchange Ahmedabad, Bangalore Stock Exchange Bangalore, Bhubaneswar Stock Exchange Bhubaneswar, Calcutta Stock Exchange Kolkata, Cochin Stock Exchange Cochin, Delhi Stock Exchange New Delhi, Guwahati Stock Exchange Guwahati, Hyderabad Stock Exchange Hyderabad, Jaipur Stock Exchange Jaipur, Ludhiana Stock Exchange Ludhiana, Chennai Stock Exchange Chennai, MP Stock Exchange Indore, Pune Stock Exchange Pune, Interconnected State Exchange of India Limited. Commodity exchanges: Multi Commodity Exchanges of India Limited CX, National Commodity and Derivatives Exchange Limited NCDEX, Indian National Multi Commodity Exchange NMCE, Indian Commodity Exchange Limited ICEX, ASE, Derivatives and Commodity Exchanges Limited, Universal Commodity Exchange UCE. National Stock Exchange NAC. On the basis of the recommendation of High Powered Fairwani Committee, the National Stock Exchange was incorporated in November 1992 as a tax-paying company. Unlike other stock exchange in the country, by Industrial Development Bank of India IDBI, Industrial Credit and Investment Corporation of India ICICI, Industrial Finance Age Corporation of India IFCI, all insurance corporations, selected commercial banks and others. In April 1993, it was recognized as a stock exchange and commenced operations in 1994. In October 1995, NSE became the largest stock exchange in the country. Trading at NSE can be classified under two broad categories: wholesale debit market, capital market. Wholesale debit market operations are similar to money market operations, where institutions and corporate bodies enter into high value transactions in financial instruments such as government securities, treasury bills, public sector unit bonds, commercial paper, certificates of deposit, etc. Indices of NSE: S&P CNX Nifty NSE 50, CNX Nifty Junior, CNX 100, S&P CNX 500, Chrysler 500, renamed in July 1998, CNX Mid Cap Nifty Mid Cap 50, S&P CNX Nifty, S&P CNX Nifty Dividend. India VIX, Bombay Stock Exchange BSE, established in 1875, BSE Limited, formerly known as Bombay Stock Exchange Limited, as Asia's first stock exchange and one of India's leading exchange groups. Over the past 137 years, BSE has facilitated the growth of the Indian corporate sectors by providing it an efficient capital raising platform named DOTS. Delhi Online Trading System DOTS was started in the year 1996. Share indices working under BSE are as follows. Sensex. It is measured by Sensory Index, and at present 30 companies are notified under it. BSE 500. BSE 500. This new index started operations in the year 1999 by BSE, and it is the biggest base index, national index. 100 companies are there in this index, and it is quoted by the regional share market. BSE 200. It is the share index of 200 biggest base companies. It is also called Dolex, as it also depicts the value of the American dollar. Indo Next. It is established by BSE and Federation of Indian Stock Exchange FIAC with the aim of liquidity among small companies, encouraging BSE Greenex. Bombay Stock Exchange on 22nd February 2012 had launched a new index called BSE Greenex, which measures the performance of the company is in terms of carbon emissions. The top ranking companies from each sector like power, steel, cement have made it to the new index called BSE Greenex. Greenex has 20 companies from the broader BSE 100 index that meet energy efficiency norms, allowing investors to derive benefit from the related cost savings. OTC Exchange of India. Over the Counter Exchange of India OTCEI was incorporated in 1990 as a company under the Companies Act 1956 and is recognized as a stock exchange under the Securities Contracts Regulations Act 1956. The exchange was set up to aid enterprising promoters in raising finance for new projects in a cost effective manner and to provide investors with a transparent and efficient mode of trading. The OTCEI is no longer a function exchange, as the same has been de-recognized by SEBI order dated 31st March 2015. Interconnected Stock Exchange ISE is a national level stock exchange providing trading, clearing, settlement, risk management, and surveillance support to its trading members. IAC aims to address the needs of small companies and retail investors by harnessing the potential of regional markets so as to transform them into a liquid and vibrant market using state of the art technology and networking. Some prominent stock indices of five famous stock markets. Index and country. Dolex, Sensex, S&P, CNX, Nifty 50, Bankex India, Dow Jones, United States, New York, Nikkei Japan, Middax Germany, Hang Seng Hong Kong, State Times CX Singapore, Kospi Korea, State Thailand. Taiwan, Taiwan, Shanghai.com China, Nasdaq USA, S&P Canada, Bovespa Brazil, Mibtel Italy, IPC Mexico. Securities and Exchange Board of India SEBI. It is the regulatory authority established under the SEBI Act 1992 in order to protect the interest of the investors in securities as well as to promote the development of the capital market. It involves regulating the business in the stock exchanges, supervising the working of stock brokers, share transport agent, merchants, bankers, underwriters, etc., as well as prohibiting unfair trade practices in the securities market. SEBI provides a high degree of protection to investors with regard to their rights and interests through adequate, accurate, and authentic information and disclosure of such information on continuous basis. In short, the SEBI endeavor to create an effective surveillance mechanism and encourage responsible and accountable autonomy on the part of all players in the market. Role of SEBI in the development of stock and capital markets. SEBI and the primary market. Companies need not obtain prior permission for raising of capital from the market. SEBI has issued guidelines for all companies for disclosure of information and protection of investors' interest. Building requirement has been introduced for issues above 100 crore. Bankers to the issue and portfolio managers have to be registered with SEBI. SEBI and the secondary market, governing bodies of stock exchange have been recognized, restructured, and broad-based. SEBI has drawn up a comprehensive plan of inspecting all stock exchanges to determine the extent of compliance with SEBI guidelines. Computerized screen-based trading has been introduced on all major stock exchanges. All stock exchange ACS have been directed to set up a clearing house or clearing corporation. Brokers, sub brokers have been brought under the regulatory framework of SEBI. Panel action is taken by SEBI against any member of violations of SEBI Act. Registers to issue and share transfer agent have been brought under SEBI. SEBI has issued guidelines pertaining to buyback of shares. Functions of SEBI. SEBI has been obliged to protect the interest of the investors in securities and to promote the development of and to regulate the securities market by such measures as it thinks fit. The measures referred to therein may provide for regulating the business in stock exchange and any other securities markets, registering and regulating the working of venture capital funds and collective investment schemes, including mutual funds, promoting and regulating self regulatory organizations, prohibiting fraudulent and unfair trade practices relating to securities markets, promoting investors' education and training of intermediaries of securities market, prohibiting insider trading in securities, regulating substantial acquisition of shares and takeover of companies, calling for information and information from undertaking inspection, conducting inquiries and audits of the stock exchanges, mutual funds, other persons associated with the securities market, intermediaries and self-regulatory organizations in the securities market, registering and regulating the working of the depositories, participants, custodians of securities, foreign institutional investors, credit rating agencies, and such other intermediaries as specified by SEBI. Credit rating. Credit rating is an evaluation of the credit risk of a prospective debtor, an individual, a business company, or a government, predicting their ability to pay back the debt and an implicit forecast of the livelihood of the debtor defaulting. The credit rating represents an evaluation of a credit rating agency of the qualitative and quantitative information for the prospective debtor, including information provided by the prospective debtor and other non-public information obtained by the credit rating agency's analysis. The credit rating agencies are Credit Rating Information Services India Limited (CRISIL), Investment Information and Credit Rating Agency of India Limited (IICRAI), Credit Analysis and Research Limited (CARE), Standard and Proofs S&P, Moody's, Fitch. Powers of SEBI. SEBI has powers to call information or explanation from recognized stock exchanges or their members and intermediaries regarding their business transactions for inspection or security purpose. SEBI has powers to compel listening of securities by public companies. SEBI has powers to levy fees or to impose monetary potential or other charges on intermediaries and other participants for a range of violations or for carrying out the purpose of regulations. It can even impose suspicions of the registration for a short period. SEBI has a power to initiate actions in regard to assigned functions. SEBI is empowered to grant approval to buy laws and also to make or amend by laws of recognized stock exchanges. Securities Laws Amendment Act 2014. In August 2014, the Securities Law Amendment Act 2014 gave SEBI additional powers, including to order the arrest or violators and seek call data records of individuals under investigation. The new amendments gave SEBI the powers to search and obtain information, including call records about any suspected entity from within or outside the firm. The main objective of SEBI Amendment Act 2014 are as follows: power of SEBI to seek permission for search and seizure from a designated court magistrate in Mumbai, excessive declaration of power to SEBI with regard to collective investment schemes, powers of discouragement, repayment, amount of profit made for the loss averted in the said fraudulent transactions. Tribunal sat powered with regard to settlement proceedings. A set of new provisions in the form of sections 26A to 26E has been inserted by the Act, which provides for the establishment of special courts for speedy trial of all offences committed under the SEBI Act, rationalizing the penalties that can be imposed under the Act. Mutual funds. Mutual funds is a body corporate registered with Securities Exchange Board of India (SEBI) that pools money from individuals, corporate investors, and invest the same in a variety of defined financial instruments or securities such as equity, shares, government securities, bonds, debentures, etc. Mutual funds can thus be considered as financial intermediaries in the investment business that collect funds from the public and invest on behalf of the investors. Mutual funds issue until to investors the appreciation of the portfolio or securities in which the mutual funds has invested the money lends to an appreciation in the value of the units held by investors. The investment objective outlined by a mutual fund in its prospectus are by binding on the mutual fund schemes. The investment objective specify the class of securities a mutual fund can invest in. Mutual funds invest in various asset classes like equity, bonds, debentures, commercial paper, and government securities. The schemes offered by mutual funds vary from funds to funds. Some of pure equity schemes, others are as mix of equity and bonds. Investors are also given the option of getting individual, which are declared periodically by the mutual fund, or to participate only in the capital appreciation of the scheme. Risk involved in investing in mutual funds. Some of the risk to which mutual funds are exposed to are given below. Market risk. If the overall stock or bond markets fall on account of overall economic factors, the value of stock or bond holding in the fund's portfolio and drop, thereby impacting the fund performance. Non-market risk. Bad news about an individual company can pull down its stock price, which can negatively affect fund holding. This risk can be reduced by having a diversified portfolio that consists of a wide variety of stocks drawn from different industries. Interest rate risk. Bond prices or interest rate moves in opposite directions. When interest rates rise, bond prices fall, and this decline in underlying securities affects the fund negatively. Credit risk. Bonds are debit obligations, so, when the funds invest in corporate bonds, they run the risk of corporate defaulting on their interest and principal payment obligations. When that risk crystallizes, it leads to a fall in the value of the whole bond, causing the NAV of the fund to take a beating. Define types of mutual funds. Mutual funds are classified in the following manner on the basis of objective. Equity funds, growth funds. Funds investing in equity shares are called equity funds. They carry a principal objective of capital appreciation of the investment over medium to long term. They are best suited of investors who are seeking capital appreciation. Diversified funds. Investment is made in companies spread across the sectors. They are generally meant for risk averse investors who want a diversified portfolio across sectors funds. These funds invest primarily in equity shares of companies in a particular business sector or industry. These funds are targeted at investors who are bullish or fancy the prospectus of a particular sector. Index funds. These funds invest in a same manner as popular market indices like S&P CNX Nifty or S&P CNX 500. The money collected from the investors is invested only in the stocks which represent the index. The objective of such funds is not to beat the market but to give a return equivalent to the market returns. Tax saving funds. These are those funds which offer tax benefits to investors under the Income Tax Act. Opportunities provided under this scheme are in the form of tax rebates under the Income Tax Act. Debit income funds. Investment made in high rated fixed income bearing instruments like bonds, debentures, government securities, commercial papers, and other money market instruments. They provide a regular income to the investors and best suited for medium to long term investors who are averse to risk and seek capital for preservation. Liquidity funds, money market funds. Investments is made in highly liquid money market instruments. The period of investment could be as short as a day. They provide easy liquidity. They act as an alternative for savings and short-term fixed deposit accounts with comparatively higher returns. Gilt funds. These funds invest in central and state government securities since they are backed by government. They give a secured return and also ensure safety of the principal amount. They are best suited for medium to long term investors who are averse to risk. Balance funds. Investment is made in some proportion both in equity shares and fixed income bearing instruments. David, they provide a steady return and reduce the volatility of the fund while providing some upside for capital appreciation. They are ideal for medium to long term investors who are willing to take moderate risks. On the basis of flexibility, open ended funds which do not have a fixed date of redemption, are open ended funds. Generally, they are open for subscription and redemption throughout the year. Their prices are linked to the daily net asset value (NAV). From the investor's perspective, they are much more liquid than closed ended funds. Closed ended funds which are open initially for entry during the initial public offering IPO, and therefore closed for entry as well as exit, are closed ended funds. These funds have a fixed date of redemption. Closed ended schemes are generally traded at a discount to NAV, but the discount narrows as maturity nears. These funds are open for subscription only once and can be redeemed only on the fixed date of redemption. The units of these funds are listed on stock exchange, which certain exceptions are tradable, and subscribers to the fund would be able to exit from the fund at any time through the secondary market. Advantages of investing in mutual funds. Small investments. Mutual funds help in reaping the benefits of returns by a portfolio which is spread across a wide range of companies with small investments. Professional fund management. Professionals having considerable expertise, experience, and resources manage the pool of money collected by a mutual fund. They thoroughly analyze the markets and economy to pick good investment opportunities. Spreading risk. An investor with limited funds might be able to invest in only one or two stocks, bonds, thus increasing his or her risk. Transparency. Mutual fund regularly provide investors with information on the value of their investments. Regulations. All the mutual funds are registered with SEBI, and they function with the provisions of strict regulations designed to protect the interest of the investors. Disadvantage of investing in mutual funds. Risk and cost. Changing market conditions can create fluctuations in the value of a mutual fund investment. No guarantee. There are no sure return as mutual funds invest in debit as well as in equities. Return depend on the market conditions. No control as all the decisions are taken by the fund manager. Investors do not have control on investment. Fees and commission. All funds charge administrative fees to cover their day-to-day expenses. Some funds also charge sales commissions or loads to loads to compensate brokers, financial consultants or financial planners. Taxes, they are subjected to heavy taxation. Selecting right financial securities is not easy. It is difficult task for a mutual fund manager to select appropriate and suitable financial securities for investment to generate higher returns. Unethical practice may creep. Mutual funds managers may follow unethical corrupt practices to boost the performance of various funds related schemes. Insurance sector in India. Industry includes two sectors, life insurance and general insurance. Life insurance in India was introduced by the Britishers. A British firm in 1818 established the Oriental Life Insurance Company at Calcutta, now Kolkata. Since the opening up, the number of participants in the insurance industry has gone up from seven insurance, including LIC from public sector, general insurance, once specialized insurance, and GIC as the national reinsurer. In 2000 to 49 insurer as on 13th September 2011, insurance companies in India offer protection against losses as they deal in life insurance, marine insurance, vehicle insurance, and so on. The insurance companies collect the little savings of the investors and reinvest those savings in the market. The indigenous insurance companies are collaborating with defined foreign insurance companies after the liberalization process. This step has been incorporated to expand the Indian insurance market and make it competitive. Life Insurance Corporation of India (LIC). LIC was established on 1st September 1956, which set the pace of nationalization of the insurance sector under the stewardship of C.D. Deshmukh. It has head office at Mumbai at 8 zonal offices, the most recent being Patna. LIC is also operating internationally through branch offices in Fiji, Mauritius, and UK, and through joint ventures companies in Bahrain, Nepal, Sri Lanka, Kenya, and Saudi Arabia. In 2008, its wholly owned subsidiary was opened in Singapore. It also extends assistance for development of infrastructure facilities like housing, rural electrification, water supply, sewage, etc. In addition, it extends resource support to other financial institutions through subscription to their shares and bonds, etc. In making investments, the major consideration is the protection of the interest of policyholders, and the aim is to secure the highest possible real consist with the safety of capital. It is the single largest investor in the country. It subscribes to and underwriters the shares, bonds, and debentures of various financial corporations and companies and provides term loans. General Insurance Corporation (GIC). GIC was established on 1st January 1973 with its four subsidiaries, which National Insurance Company Limited Kolkata, the New India Assurance Company Limited Mumbai, the Oriental Fire and General Insurance Company Limited New Delhi, United India General Insurance Company Limited Chennai. These four subsidiaries delinked themselves from GIC in 2000 and formed an association known as General Insurance Public Sector Association of India (GIPSA) with headquarters in Delhi. As on 21st March 2003, GIC ceased to be a holding company of its subsidiaries. General Insurance Corporation of India Reinsurer (GIC Re) was approved as the Indian reinsurer on 3rd November 2000. GIC Reinsurer Re has branched offices in Dubai and London and representative office in Moscow. General insurance in India. The entire general insurance business in India was nationalized by General Insurance Business Nationalization Act 1972 GIVNA. The Government of India GOI through nationalization took over the shares of 55 Indian insurance companies and the undertaking of 52 insurance carrying on general insurance business. Insurance Regulatory and Development Authority of India IRDAI. The Insurance Regulatory and Development Authority of India was established in the year 1999 by the Indian government for two significant reasons: to safeguard in the interest of the policyholders and for the upgradation of the entire insurance sector, right from the approach adopted by the existing insurance companies towards their shareholders to the eradication of the shortcoming of industry. The organization was set up under the guidelines of the Insurance Regulatory and Development Authority Act 1999. Scope of IRDAIs. IRDAI has been authorized to register the new insurance companies in India. The list of new insurance companies also included the collaboration of the renowned insurance companies overseas with the existing Indian companies. The insurance companies in India are required to approach the Insurance Regulatory and Development Authority for the purpose of renewal of the registration. The Insurance Regulatory and Development Authority is allowed to withdraw registration of companies and even cancel the registration of company. It if required, it is also authorized to modify the registration procedure for a company. Functions of IRDAI. The IRDAI ensures and safeguards the interest of policyholders through various ways such as nomination by the policyholders, settlement of insurance claims, practical training for insurance agents and other intermediaries, insurable interest, surrender value of policyholders, code of conduct of insurance intermediaries, assistance in gaining correct information about policies, creation of management information system, promotion of self regulation within the insurance sector.